corn starts slipping from here, a lot of spring marketing plans will start slipping with it. That is one quiet risk sitting underneath the market tonight. Nothing on the board looks dramatic at first glance. Corn is steady, soybeans are steady, cattle are steady, crude oil is holding firm. It feels calm. But calm markets and seasonal turning points are often where the biggest positioning mistakes are made, because sideways trade builds confidence. Confidence builds exposure, and exposure becomes dangerous when momentum finally shifts. Tonight, we're going to walk through grains, livestock, energy, and the underlying pressure points that matter right now, because what we are seeing is not volatility, it is positioning. And positioning ahead of planting season always carries risk. Starting with corn, May corn is trading near 436, essentially unchanged from the previous session. On the surface, that looks stable. Stability tends to make producers feel comfortable. But what matters here is not just the price level, it is the behavior. Corn has stopped falling, but it has also stopped attracting aggressive buyers. That creates a narrow balance zone where neither side has full control. When markets sit in balance too long, they begin to rely on continued participation to hold that structure together. If demand improves, this market can slowly grind higher and regain confidence. However, if demand hesitates or export flows soften, corn does not need a sudden shock to move lower. It only needs buyers to step back. When that happens, support begins to feel less secure, sentiment shifts, and patience starts to erode. This is often how seasonal traps form, not through sudden collapse, but through quiet drift that catches positioning off guard. Moving to soybeans, May beans are trading near 1156, modestly higher. Soybeans are not surging, they're repairing, and repair markets are inherently fragile. When a market is rebuilding, it needs continued confirmation to maintain momentum. If export demand strengthens or global supply concerns tighten, soybeans can extend higher fairly quickly. However, if supply remains comfortable and demand fails to accelerate, rallies begin to fade and the market loses energy. Danger in soybeans tonight is not immediate weakness, it is exhaustion. Sideways movement can gradually invite sellers back into the market, and once that shift begins, the tone changes quickly. Soybeans are stabilizing, but stabilization should not be confused with strength. Chicago wheat did not show a clear quote on our board tonight, but wheat continues trading near recent levels and is still searching for direction. Wheat has not committed to a sustained trend, and historically, wheat markets do not drift quietly forever. They tend to move in response to global triggers such as weather developments, export competition, and geopolitical shifts in supply. Right now, wheat appears to be coiling rather than trending, and coiled markets often deserve attention because when they finally move, they tend to move quickly. Shifting into livestock, April live cattle are trading near $243.52, up roughly a dollar. The broader structure remains supportive, and supply fundamentals continue to provide a strong foundation. However, strong markets also test conviction at elevated price levels. Today's movement looks like continuation rather than acceleration, which suggests the market is maintaining strength but not expanding it. The key question becomes sustainability. If cash markets continue supporting futures, this structure can remain intact. If cash strength begins to soften, futures tend to respond quickly. Momentum at higher price levels rarely disappears slowly. It tends to shift more abruptly. Feeder cattle are trading near $363.80 and slightly softer. This does not necessarily indicate weakness, but rather consolidation within the broader firm structure. However, feeder psychology remains closely tied to feed cost. If grain markets begin to wobble, feeder sentiment often follows. That relationship becomes increasingly important during periods of potential volatility because it can amplify movement across both markets. Lean hogs are trading near 93.50 and are showing solid gains. Hogs appear to be stabilizing after previous pressure, but hog markets historically move faster and with more volatility than cattle. Momentum is improving, yet conviction remains moderate, which keeps the potential for a sharp movement present. Stability in hogs tonight does not eliminate volatility risk, it simply reflects temporary balance. In energy, crude oil is trading near 66.53 and modestly higher. Energy does not need to surge to influence agricultural margins. It simply needs to remain firm. Fuel, fertilizer, and freight costs all respond to sustained energy levels. When grain markets stall and energy remains supported, margins tighten gradually. This type of pressure rarely appears dramatic in the short term, but it accumulates over time and can become significant. Tonight's crude movement does not indicate a surge, but it does reinforce ongoing cost pressure. Weather does not present immediate extremes, but expectations are beginning to form. Early planting outlook, moisture patterns, and acreage sentiment all shape how markets position themselves ahead of the growing season. Markets react not only to current conditions, but to changes in expectations. If weather patterns begin to shift, sideways grain trade can transition quickly. At the moment, weather is not forcing movement, but it is influencing positioning. Stepping back, the broader picture shows a collection of markets sitting at decision points. Corn appears balanced yet fragile. Soybeans are stabilizing but not fully convincing. Wheat remains coiled. Cattle are firm but testing sustainability. Hogs are stabilizing with underlying volatility, and crude is firm enough to maintain cost pressure. This is not a breakdown environment, but it is not a clear breakout either. It is a decision zone, and decision zones before planting season carry meaningful risk. The primary risk is not an immediate collapse, but rather positioning too heavily into perceived stability just before momentum shifts. Calm markets often create comfort. Comfort encourages exposure, and exposure magnifies movement when directions change. From a broader agricultural perspective, demand pace remains to grain sentiment. Strong export demand can extend stability, while inconsistent demand introduces drift. Input costs remain supported by firm energy markets, maintaining pressure on margins even without dramatic price movement. Livestock fundamentals continue to provide long-term support, yet futures markets respond more to changing expectations than to static fundamentals. When expectations shift, price movement often follows faster than anticipated. So where does this leave us tonight? Markets do not appear chaotic, but they do not need to in order to carry risk. Corn is steady, soybeans are steady, cattle are steady, and crude is steady. What we are seeing is not volatility, but positioning, and positioning during seasonal transition deserves attention. The next directional move rarely announces itself loudly. It often begins quietly. By the time it becomes obvious, the early opportunity has already passed. This is Boots and Bushels, Markets Under Pressure.